S&P 500 futures are flashing green right now, 0.4%.
While the Nasdaq 100 is pushing even higher, leading the charge at plus 0.5%.
And we are seeing the VIX rapidly retreating from that massive 30-handle peak we saw earlier this week.
It is Tuesday morning, March 10th, 2026.
The opening bell hasn't even rung yet.
But if you are looking at the pre-market volume, you know we're staring down an incredibly volatile implied open.
Today, we are bypassing the sanitized front page news because we've got our hands on an internal, highly tactical sit rep.
Right, it's a pre-market broadcast script directly from the institutional desks over at Bulls, Bears, and the Bell.
The mission of this deep dive is to cut through the intense financial jargon.
We need to decode exactly what the smart money is planning to do before the bell rings.
Okay, let's unpack this, because the overarching market sentiment jumping off the pages of this briefing is a concept they're calling fragile neutrality.
And that fragile modifier is the most important word in the entire sit rep.
We are looking at a market that is, aggressively hunting for a reason to move higher.
Rather than a genuine fundamental reason to stop falling.
Right, you're seeing this overnight session pump being treated like a definitive gap and go set up by retail traders.
But the structural foundation underneath this price action is incredibly thin.
The absence of immediate bad news is temporarily masquerading as a bull thesis.
And that temporary bull thesis is entirely geopolitical this morning.
The pre-market action is a direct violent reaction to headlines out of Washington and the Middle East.
President Trump has signaled the ongoing conflict with Iran could end soon,
with a very specific emphasis on keeping global oil flows open.
Literally, as we record this, G7 energy ministers are in a virtual meeting discussing strategic reserve releases.
And just to be clear for everyone listening, because we are dealing with highly charged political figures and global conflicts, we are strict neutral observers here.
Absolutely.
We take no political sides regarding the former president's statements or the international conflict itself.
Our only focus today is how the algorithms and institutional capital are pricing in these specific headlines.
Because the algorithms don't have political affiliations.
They just have risk parameters.
And the immediate reaction to that de-escalation narrative is a massive unwinding of the war premium in the energy sector.
We are watching WTI crude completely plunge.
Tumbling back down from those panic buying highs, slicing through $88.
And it's looking like it wants to test the $81 range.
But hold on, if oil prices are crashing, doesn't that massive relief at the gas pump naturally offset the recession fears we've been dealing with?
I mean, a 9% collapse in crude oil is a huge break for consumers and businesses.
Why is the institutional playbook treating this morning's action with such extreme caution?
If we connect this to the bigger picture, that 9% collapse in crude acts as a massive disinflationary pulse across the global economy.
Earlier this week, the dominant fear was energy-driven inflation ripping higher,
forcing central banks into a corner.
So this sudden drop in oil completely caps those immediate inflation fears.
But the real risk here is that it provides a smokescreen.
Because it removes the immediate inflation panic, the market is choosing to completely ignore the absolutely dismal labor data we just got.
You're talking about that brutal February print.
Negative 92,000 jobs.
That is textbook stagflation data, shrinking employment while prices were rising.
Exactly. But the market can only focus on one crisis at a time.
Today, the relief of cheaper energy inputs is outweighing the structural fear of a weakening labor market.
The institutions know this is a temporary psychological relief, not a fundamental fix.
Which brings us to how they're actually trading this pre-market.
Let's get into the mechanics of that, because the sit rep explicitly labels the current price action a liquidity trap.
We need to look at the exact lines in the sand the institutions are watching right now.
For the S&P 500 futures, the ES, that absolute line of the sand, is 6,900.
Above that, you have what the briefing calls a froth ceiling.
Heavy institutional resistance, sitting between 6,950 and 7,000.
And on the downside, structural support does not kick in until 6780.
For the Nasdaq 100 futures, the NQ, the line of the sand, is 25,170.
If it somehow breaks out with real volume, the target is the all-time high resistance at 26,250.
But if it breaks down, the floor falls out all the way down to 24,650.
So what does this all mean for the open today?
Let's look at the anatomy of this liquidity trap.
Retail traders wake up, check their brokerage apps over breakfast, and see this sea of green futures.
Driven by these peace headlines.
They start throwing market orders at the open, aggressively buying the pump.
They are the ones providing the localized liquidity.
And the smart money is waiting right there at that 6,800 to 7,000 ceiling on the S&P.
Happy to sell them their shares.
It's the classic Wall Street bait and switch.
Think of it like a casino opening its doors, flashing all the bright lights, offering free drinks.
Only to quietly lock the exit door.
Retail is flooding in, completely blind to the fact that institutional players are using that buying pressure to quietly trim their positions.
Heading for the exits without crashing the bid.
But how do we know it's a trap and not a legitimate breakout? What are the technical footprints?
The sitrep points to 3 specific technical red flags, proving they aren't actually buying this rally.
First, the volume on these pre-market rallies is thinning out rapidly.
A real convicted rally has massive institutional volume behind it. This is running on fumes.
Second, they note a Kijun rejection on the hourly charts.
The longer-term momentum is still firmly bearish, and the price action is just bouncing off that descending trend line.
And third, the algorithms are just spinning wheels inside a symmetrical triangle.
The market is expending a massive amount of energy moving up and down violently, but structurally it isn't going anywhere.
So the conclusion from the institutional desk is pretty brutal.
If the S&P 500 cannot reclaim and hold that 6,900 level with actual volume by midday today,
this entire morning rally is nothing but a dead cat bounce.
headed straight down to test 6,600 by Friday.
That is a massive reversal to prepare for.
It is. But even inside a trap, capital is always flowing.
The war premium evaporating means we are seeing a violent sector rotation.
Capital is flooding out of those defensive energy and value stocks that were working last week.
And it is pouring right back into high-duration growth and semiconductors.
The sitrep highlights several specific pre-market movers dictating the action today.
Let's start with the heavy hitter NVDA. It is up 1.2% pre-market.
NVIDIA is actively trying to pivot the narrative away from macro geopolitics.
Back to pure technology.
They are reportedly pitching a new open-source AI agent platform called NemoClaw.
And the key here is who they are pitching it to. Heavyweights like Google and Salesforce.
This isn't just about selling hardware anymore. It's about embedding themselves so deeply into the enterprise software ecosystem
that they become indispensable regardless of what the broader economy is doing.
But then you have Oracle.
The sitrep calls Oracle the ultimate show-me stock today.
It is trading flat right now, but there is massive options volume building up ahead of their Q3 results coming out after the bell.
Is Oracle actually a safe bet here, or are they just riding the broader AI coattails?
The options market is demanding perfection from Oracle today.
The entire focus is on their cloud infrastructure division, OCI.
Traders aren't just looking for growth. They are demanding 60% plus growth to justify the massive AI infrastructure narrative.
If they print 58%, the market will likely punish them.
The critical levels the institutions are watching are a bull breakout at 148.
Or a severe bear case plunge down to 124 if OCI adoption shows any signs of slowing down.
Then you have Micron Technology riding a massive 5% surge in the pre-market.
And this isn't even driven by their own news.
It's entirely sympathetic movement driven by their Asian partners, Samsung and SK Hynix,
signaling a severe high-bandwidth memory shortage.
Micron is effectively the preferred beta vehicle right now for institutional investors.
They want aggressive, immediate exposure to the chip sector without taking on the sheer size of NVIDIA.
The breakout bull level for Micron is 112.50.
But if it fails to hold and breaks below $98, the sitrep warns that broader AI fatigue is taking over the semiconductor space.
We also need to look at NIO, the electric vehicle maker.
The sitrep is using NIO as a proxy for Chinese consumer sentiment,
which puts it in a fascinating macroeconomic tug-of-war right now.
On one side, the de-escalation of trade war rhetoric is a massive relief for them.
But on the other side, cheap oil puts immense pressure on EV demand.
If gas is practically free, the consumer incentive to switch to an EV plummets.
The bull level to watch there is $5.20, and the bear level is $4.10.
And just to prove that not absolutely everything is chained to the macroeconomic environment, the sitrep points to Vertex Pharmaceuticals.
They gapped up 4% on the open.
Simply because they released highly positive Phase 3 data for a kidney disease treatment.
It's the perfect example of an idiosyncratic win.
Proving that if a company actually delivers real fundamental pipeline results, it can still outrun the geopolitical noise.
What's fascinating here is stepping back to that tech sector rotation.
The underlying narratives the institutions are trading is what they call the AI memory supercycle.
They're betting that with lower energy input costs and a stabilized geopolitical backdrop,
These massive tech companies are going to greenlight the next huge wave of data center capital expenditures.
if you don't have to worry about a war disrupting your supply chains or $120 oil completely blowing out the power costs for your data centers.
You can get back to buying AI chips.
But the sitrep makes it incredibly clear that this entire tech relief rally is existing on borrowed time.
It all comes down to the macro overlay.
The institutions identified two massive forces dictating tech's survival today.
They call them the twin titans, the 10-year Treasury yield and the dollar index, the DXY.
These two metrics are essentially the gravity of the financial world.
Right now, the 10-year yield is hovering at 4.11%, which is down from a peak of 4.21% yesterday.
And the dollar index is sitting at 98.6, down 0.5%.
That specific cooling off in yields and the dollar is exactly what is giving high-duration tech stocks the breathing room to execute this gap and go this morning.
But here is where the sitrep issues its most severe warning.
Something that heavily leveraged retail traders often misunderstand entirely.
They call it the growth valuation trap.
You look at the Magnificent Seven, these mega cap tech monoliths, and you think these are those profitable companies in human history.
They print free cash flow. I'm perfectly safe hiding my capital here during a storm.
Right. The logic is that people will always use Google. They will always need Microsoft, so the stock is bulletproof.
And that assumption is exactly the trap. Let's break down the mechanics of the pain the institutions are preparing for.
If that 10-year yield reverses its morning dip and spikes back above 4.30% read,
the first thing to break isn't a tech company's earnings report.
NVDA or Oracle could still be executing flawlessly and making billions of dollars.
What breaks is their multiple, the premium that investors are willing to pay for those future earnings.
It's like buying a house. If mortgage rates suddenly spiked, the house didn't get any smaller, the roof didn't start leaking.
The fundamental shelter value of the property is exactly the same.
But the price the market is willing to pay for that house drops instantly because the cost of capital shifted.
That is the perfect analogy. The math laid out in the sitrep is staggering.
A mere 20 basis point jump in the 10-year yield can instantly shave 5 to 10% off the fair market value of a high-growth stock.
Instantly. Even if the company's fundamentals are flawless.
Because suddenly the risk-free rate of return on a government bond is so attractive.
Investors demand a massive discount to take on the risk of holding equities.
So even if NVIDIA executes perfectly on NemoClaw, the stock still drops because the macroeconomic gravity shifted.
And this leads directly into what the institutional playbook calls the ultimate pain trade.
The pain trade is a scenario driven entirely by forced liquidation.
Imagine retail traders who are highly leveraged across various sectors.
If yields spike and the broader market starts to crack, those traders are going to get margin calls.
To cover those margin losses, they are forced to sell whatever they can actually liquidate quickly.
Which almost always means dumping their highly liquid winning AI and semiconductor stocks.
It's like being forced to sell your prize-winning racehorse just to pay off a bad bet you made at the poker table.
You get this vicious cascading cycle where the best stocks in the market are sold off the hardest.
Simply because the system needs cash to cover bad bets elsewhere.
Which is absolutely terrifying if you're just sitting there holding tech stocks, completely ignoring the bond market.
Thinking you're safe from the macro environment.
And the sitrep points to a very specific imminent event today that could trigger this exact cascade.
The 1 p.m. Eastern Time 3-year note auction.
If the demand for those government bonds is weak at 1 p.m., yields are going to tick right back up.
And this entire morning tech rally could just evaporate into thin air.
Leaving retail holding the bag at the top of that 6,900 resistance level.
It's the ultimate test of the fragile neutrality theory.
The equity market is desperate for stability, but an auction with weak demand tells us that the bond market isn't buying the peace narrative at all.
Because the bond market traditionally sniffs out risk much faster than the stock market.
So bringing this all together, we are currently sitting in what the institutional playbook calls the eye of the storm.
On one side, we have this massive geopolitical relief rally driving crude oil down and tech valuations up.
On the other side, we have institutional algorithms setting up aggressive liquidity tracks, quietly ready to dump their positions on retail buyers,
And looming over all of this is tomorrow's CPI data.
which could completely rewrite the inflation narrative and the rules of the game before the week is out.
The actionable intel from the bulls, bears, and the bell sit rep is definitive.
Be extremely cautious, respect the structural levels, and whatever you do, avoid throwing blind market orders into the implied open.
It is all about recognizing the specific environment you are operating in.
But there's a final lingering thought here that really builds on everything this institutional data is telling us.
We've seen how quickly these massive funds use geopolitical peace headlines to trim their positions.
Setting the trap and leaving retail trapped at the highs.
But what happens to this entire market architecture, these highly leveraged, algorithm-driven setups we've just decoded, if the underlying peace narrative turns out to be a complete diplomatic headfake?
That is the trillion-dollar question.
If the global market is this hypersensitive to a single headline about the Strait of Hormuz on a Tuesday morning,
What are we actually doing here? Are we investing in company fundamentals anymore?
or are we just trading the speed of the news cycle?
Exactly. If a 60% growth rate in Oracle's cloud infrastructure division can be entirely derailed by a 20 basis point move in the bond market,
Which was in turn driven by a geopolitical rumor from Washington.
the entire concept of long-term fundamental investing looks very different.
The algorithms aren't reading balance sheets today. They are reading headlines.
Are you buying the company, or are you just buying the algorithm's reaction to the morning news?
Keep your eyes on those key lines in the sand.
Watch the volume at the 1 p.m. bond auction.
And above all, stay sharp and keep questioning the data.
We hope this deep dive gave you the decoder ring you need to navigate today's implied open. Thank you so much for joining us, and we will catch you next time.